I'm Glenn Freeman from Morningstar, and I'm joined today by Morningstar's Senior Credit Analyst, John Likos. John, thanks for joining us today.
It's good to be here.
Just firstly, John, what's your outlook for Australia's hybrid sector for 2017?
Yeah, sure. Look, I think this year we have a range of technical factors which should support hybrid pricing. By technical factors, I'm largely referring to supply issues. We've already seen a couple of issuers come to market and not replace their hybrids in the last few months. So we've seen Woolworths, we've seen Origin, and we believe we're probably going to see some other issuers do the same thing through this year. And they include companies such as Caltex, possibly Goodman's as well. And there's a possibility that one of the major banks might not replace their listed security with another listed security. They might replace it in the wholesale market. And I'm referring to the ANZ HAs there. So if that's the case, then we're going to see a significant amount of money on the sidelines waiting for opportunities in this space. So we've calculated approximately $2.5 billion worth of money might be sitting on the sidelines after issuers call their notes without replacing them. And the ANZ note lifts that up to just over $4 billion. So look, we think that'll be a strong technical tailwind. Of course, that won't count for much if the market and the economic backdrop fall away and offset that. But that's not our base case scenario. We continue to think the economy will continue to perform at a reasonable rate of growth, which should, in line of the supply issues as well, provide a reasonable backdrop for hybrids. However, in saying that, I don't think we're going to see the rapid price appreciation as we witnessed in late 2016.
And can you talk a little about National Australia Bank's recent hybrid issue and why we supported this?
Yeah, absolutely. Look, the NAB came to market and issued the NAB subordinated notes 2. Now, they are a T2 product, so they are not like the Tier 1 hybrids that the market is generally more familiar with. The Tier 2 has more bond-like features. For example, it doesn't have a capital trigger, whereas the Tier 1 securities do have a capital trigger. And what a capital trigger is basically is should the Common Equity Tier 1 ratio drop below a certain level, then they effectively have to be converted into equity. These don't have that. They do have, however, the non-viability trigger, as the new AT1s do. However, in saying that, they also have an event of default provisions, which is much more bond-like, meaning that you can't miss a payment without that meaning a default for the issuer, whereas the AT1s, the more common ones, you can defer your distributions, if you like, even though there's a dividend stopper. So look, there are more bond-like features. We believe it adds significantly to the quality of investors' portfolios by stabilising a large part of it. It is far less volatile in a down market than what we'll find the AT1s will be. So look, we really like the product, and we thought the price was fair. You'd always like a little bit more, but we still thought the price was fair where it was, and we had no hesitation in recommending that for our investors.
And John, do you expect some of the other major Australian banks will follow suit with issues this year? And what are some of the risks that investors need to be mindful of if this is the case?
Yeah, look, we do expect further issuance this year. When there's a note that's due to be called or maturing, generally speaking, you'll expect the issuer to reissue. And so we do have a couple of notes that are due to be called this year, and that includes the Colonial notes, also some of the ANZ notes as well. So look, we think there will be replacement trades in that space. The interesting one, of course, is the ANZ HA. That is a Tier 2 product. Now, whether or not ANZ opts to come back into the listed market with that, or whether they opt to go into the wholesale market, I really think that's a 50-50 play at the moment, which goes back to the supply driver that I mentioned before. But nevertheless, we do expect to continue to see the banks tap into this hybrid market. In terms of risks, look, there's always risks. The biggest risk with hybrids is not understanding what you're buying. So we need to always ensure that investors are aware of what they're buying, and they're aware of key terms such as the non-viability trigger and the capital trigger. So that's critical. Now, those triggers go back to the capital levels of the banks, and therefore for hybrid owners, you find that the greatest risks are related to issues surrounding capital levels. Banks are very well capitalised at the moment. We believe they'll continue to be well capitalised, but should there be any shock to the system, whether it's a housing related shock, whether it's a US influenced shock in funding costs, it could well impact some of their bottom line capital numbers, which could then flow on to the pricing and the hybrid products. Again, that's not our base case scenario, but look, these are issues that investors must continuously be on top of.
John, thanks very much for your time today.
Thank you.
I'm Glenn Freeman for Morningstar, and thanks for watching.